back. You're watching Indian Open right here on Bloomberg Quint Live. We're taking a look at Asia right now. You've got the rest of the pack doing okay for itself. So you've got Nikkei 225 up 1/3%. Hong Kong's up 1/3%. China trading absolutely flat. And India, SGX Nifty trading absolutely flat. So no major cues to be taken from there. But in yesterday's session, you did see a little bit of exhaustion coming in towards the end of trade because we actually didn't land up closing towards the highs of the day, which was the case in the previous few trading sessions where you maintained the gains of the day and you actually landed up closing towards the highs of the day. Yesterday's session saw an absolutely flat close on the Nifty 50 and on the Sensex as well, though the banks did relatively well, Neeraj.
Yes, they did. Let's wait and watch if indeed that uptick continues, and for specific pockets, say for HDFC Bank, the banking space did okay. Let's see what happens to IT as well, because that's been a little bit of a cloud.
Yep, and let's see what's happening in the derivative space as well today. Today is the weekly options expiry, so how are we set up for that? Agam Vakil is standing by with the information. Agam.
Well, there are lack of cues at this point in time, honestly, considering we're not looking at too much change. Let's quickly bring up the Nifty futures. Very little change in the Nifty futures, the Nifty banking futures. The picture isn't any different. Less than 1% increase. The VIX, however, has gone down by around 4%, and that perhaps is the big positive. Don't forget, the cabinet meet did announce a lot of measures, which means that it leaves us very little with respect to the budget. But however, of course, there very well could be surprises, but that's not something the markets are expecting based on the contraction in option premiums. Moving on to your options, again, writing around the 11,700, 11,900 puts. And as far as your total open interest distribution is concerned, again, the same 500-point range between 11,500 and 12,000. Moving on to stocks, the put-call ratio, of course, also remaining largely where it is. But as far as stocks are concerned, the Iman Housing Finance in the F&O band, Reliance, Capital enters the F&O band. In terms of other stocks that we are watching out for, we have IGL and MGL, which I'm keeping an eye on, considering a lot of weakness coming in. Just Dial, of course, looking at strength. On the other hand, stocks which are seeing unwinding, Bank of Baroda, Torrent Power, and ONGC. So we'll be watching out for these names, but likely consolidation in the benchmarks according to the indications of the derivatives markets.
All right, Agam, thanks very much for joining in with the details there of what's the setup like within the F&O pocket. Parthiv Shah, Director, TRACOM Stockbrokers, is joining us on the show this morning. Parth, thanks very much for taking out the time. Let's talk about your approach to individual stocks now, and how do you plan to start investing, whether or not the bulk of your investment sticks to the large caps, or whether or not you start to diversify, look at those smaller mid-tier names that have been buzzing over the last few days.
Good morning, Devina. See, Devina, I think putting the budget aside, because I think a lot of emphasis is always given to the budget as an event, but we know for the fact that for the markets, it's eventually, I think, how the fundamentals pan out and how the earnings come out. Yes, the budgets can give pointers in terms of the government's intent to drive growth. And we always debate about the fact that the talks that are there in the budget vis-a-vis what execution happens on the ground, I think always have some sort of kind of a distance. But I think the intent will be important for the market sentiment. And I really doubt that, the FM, or for that matter, the entire budget could be game changer for the market sorts in terms of seeing a V-shaped recovery in what sort of valuation de-rating we have seen. But no two ways about it. I think these are the times when one really gets very, very good opportunities, unlike what we saw in 2017, where the large caps, mid caps, small caps were at historic highs in terms of the valuations, and post which we saw that the earnings are declining, and as a result of which they have really contracted. And I'm reading a lot of reports talking about the fact that currently the setup in the small and mid caps is such that they're quoting at valuations of 2014 or maybe 1 year prior that. And in terms of the market cap also, I think from the peak of 2017, we have seen almost 20-30% decline. So no two ways about it. This is the pocket from where the next multi-baggers would emerge, and it will be very, very important to see which companies are able to sustain this current carnage of lack of credit in terms of NBFCs not dispersing, banks being very selective, and all hopes about the PSU banks coming back into the lending foray. So I think they are very, very challenging times, but one will have to keep a very selective approach to one's portfolio in terms of, I think, all the talks that we always have, that balance sheet strength, the corporate governance standards, the management quality, the business model, all I think will be tested in current scenario. So anyone making a new portfolio or anybody having one existing portfolio needs to restructure and have the right kind of approach towards it.
Parthiv, heard the term multi-bagger after some time, so inclined to ask you, what is that potential multi-bagger idea? We may all go wrong out here. It may not turn out to be a multi-bagger, may turn out to be a flat stock or just a marginal gainer. But where is that one idea where you have a multi-bagger conviction?
See, Neeraj, I have a very simple definition of a multi-bagger. I think many people say that it's in 5 years, it's a 3x or a 5x or a 10x, or some people are even greedy 50x. My simple definition is if I can get a stock idea which can deliver a growth in terms of its returns compounding, which is upwards of 20%, I believe it's a multi-bagger for a current state of Indian markets. And I think, yes, one theme that I feel that, can really bring in multi-baggers is the chemical theme. And amongst the chemical and specialty chemical things that we talk about, I think one stock that I've already discussed in the past, which is alkyl amine. I think this is a company which is, I think, not massively re-rated. Likes of Vinati Organics, Aarti Industries, we've seen what sort of potential they have brought in. And I think alkyl amines is into very important chemical entities which are, I think, supplying to a lot of pharma companies who are now starting to focus in the domestic markets. And I think now we also know for the fact that China, being a $120 billion pharma market, has slowly opened its doors for many of the Indian pharma companies. Indian pharma companies having US FDA approvals will be allowed to sell in the Chinese market within 1 year. So which is, I think, very, very important blockbuster news. And I think a lot of Indian pharma companies are looking for domestic sourcing. And I think all the products that they make, acetonitrile, alkylamine, methylamine, ethylamine, I think they are very, very important products which goes into the pharmaceutical and FMCG industry. And these guys, I think, are also in a capex mode entirely from internal accruals. They're not going to stretch the balance sheet. And I think this is a company where one can easily pencil in next 3 or 4 years of earnings growth of upwards of 20%. And in which case, we know companies which have delivered consistency in terms of the earnings growth of 20-25%, I think tend to become multi-baggers of sorts. And I think very good credible management and a good dividend payout as well. So I think this is one company that I feel investors should have in their portfolio.
Okay, alkyl amines, that's a stock which over this year though has not done a whole lot much. 4.5% only on the stock, but it's at 839. More stocks to talk to Parthiv about, but then in just a few moments. Let's quickly go across to our research team. They're standing by to highlight, as usual, the stocks that are in the news this morning. Whether or not they have an opening impact is something we'll have to wait and watch. But brokerage calls also, Darshan joins in for that. Let's start off with you first, Mr. Count, some stocks and news.
Yes, the first on the list is Uniply Industries. Kuwait's Markab has made an open offer for 26% of the voting share capital at 82 rupees per share, which aggregates around 405.6 crore rupees. The offer price is at a premium of 29% to the current market price. Then we have a downgrade for McClure Russell. ICRA's downgraded the short-term, long-term and short-term borrowings to default from B- and A4 for borrowings worth 1,031 crore rupees. Now, these ratings continue to remain on the issuer not cooperating category, and the rationale behind the downgrade was due to the recent delays in meeting the debt obligations. Cox & Kings defaulted in the payment of interest of non-convertible debentures worth 7.2 crore rupees, which was due on June 30th. The principal amount of the NCD stood at 300 crore rupees, and the company has already defaulted twice with a cumulative default of 200 crores. Last on the list is Mindtree. Nalanda India Fund reduced stake from 10.6% to 1.7% in the company, and the shares were tendered by Nalanda in the open offer.
All right, Mishka, thanks very much. Darshan, brokerage calls for today.
Yeah, so two important. First of all will be Titan, in which Morgan Stanley has downgraded the counter. And the sole reason that they've downgraded is because they believe valuations are now at the peak, and they are reluctant to push multiples beyond the current level. Remember, it's one of the most expensive consumer companies that is trading today. That's why they've kept the target price at 1,300. They're saying it still remains their favorite play as far as long-term play is concerned, but at these valuations, they would rather switch to a Jubilant Foodworks, which they believe can come to levels of 15-25. So that's a switch. Nothing wrong with the company, but valuation-wise, they have downgraded. And Nomura has downgraded Cummins India. They've downgraded it to a reduce from a neutral, and they have cut the target price to 700 from 765. They are saying that the margin and pricing headwind will persist. FY20 will again be a weak year as companies are guiding to a lower capex as far as equipment is concerned. Exports are also likely to remain weak for the company, and the current prices is building in a 23% ROE and 16% decadal EPS CAGR, which they believe is very, very aggressive and not sustainable.
Okay, Darshan as well as Mishika, thanks so much for joining and giving us that perspective. Finance Minister Nirmala Sitharaman will present her first budget tomorrow. The biggest challenge before her is to boost economic growth without a significant compromise on fiscal prudence. So what do foreign investors expect from the government this time? To discuss this, we are joined by Mark Mobius, partner and co-founder at Mobius Capital Partners, joins us from our studio in Singapore and is a veteran of arguably many Indian budgets and many emerging market budgets as well. Mark, good having you. Thanks so much for joining in. What's your sense? The first budget of the new NDA government, they probably have the leeway in the parliament, but do they have the leeway on the balance sheet to spur growth in the Indian economy?
Well, the good news is a woman in charge, and I think that's probably going to be a very good thing for the budget. I think a woman can watch these pennies much more carefully. But I believe the government has a lot of room. First of all, they can lower interest rates further. And, you look globally, interest rates are headed down almost everywhere. In Europe, it's a negative rate. It's just insane what's happening. But the reality is it's very good for India. The other thing is I believe that the Indian government could afford a greater deficit. I believe 3.5, I think it is now, against GDP could go up. And they have a lot of room. I believe they could go to 5.
All right.
So there's a lot of leeway. But the bottom line is how the government is going to spend this money going forward and how they're going to increase two things. One, employment, and infrastructure spending.
So just let me get this clear. When we talk to our Indian economist, a print of 3.4, which was the estimate fiscal number, if that gets pushed to 3.6, that could have a negative setback. But you're saying even if it goes up till 5, it's not that bad.
Exactly, because you have a fast-growing economy. The economy needs more and more finance. I mean, if you look at infrastructure spending in China compared to India, India is about 15% of what China spends. And India is not 15% of the population of China. So India has to do a lot more in terms of infrastructure spending. And by doing that, it will boost productivity and it'll boost the economic growth of the country. And therefore, the deficit will not have a big problem because the government will be bringing in more taxes.
But that too is a bit of an issue right now because their tax collections have not been up to the mark, which puts their FY20 projections in question. So if you're talking about expanding your the fiscal deficit number, you need to back it up with the income from somewhere else, right?
Well, I believe that another factor is privatization of state-owned enterprises. I think the government can bring in a lot more income by selling off a lot of the state enterprises, or at least selling off parts of them, which will do two things. First, it'll help the budget, and secondly, it'll increase productivity. So I think that's one area they have to look at. But don't forget, we're looking at short-term. Yeah, short-term, there are problems with tax collection, but long-term, I believe if the government is able to make the bureaucracy more efficient, that'll be not a big problem. They have to make it easier and with less bureaucracy and make it almost automatic paying of taxes.
Mr. Mobius, just a point, because you look at so many emerging market economies and you've looked at them for so many years, if indeed there is a fiscal slippage that happens from the path that was earlier guided to, but it is used for presumably spurring growth, you believe foreign investors will not be perturbed. The other fear, of course, is that rating agencies might come in and have some action on their rating on India as well. Even that, to your mind, will not deter a foreign investor?
I don't think so. Of course, if the rating agencies put India into the B minus or C class, then that's a different story. But I believe that that's not going to be a big issue. The big issue for investors is growth, and infrastructure, of course, contributes to this growth. So important, and unemployment. Those are the big issues that have to be tackled by the government. Once those are tackled, then all the other issues will take care of themselves.
What about, let's work with an assumption that there is some minor tinkering on the fisc and that is used to spur growth, and there are no other major large negatives in the budget. Does India then look favorable, or would you believe that India would largely remain a bottom-up story irrespective of what happens to the benchmark indices? Because I believe that was your view the last time.
Well, I believe you can see what's happening to the benchmark. The index for the stock exchange is doing very, very well. And that means that investors are having a belief that India is on the way. They're going to make the changes that will be very good for the economy. So I don't think that's a big issue. What I think we have to see now is some real, very forceful movement on the part of the government to bring these issues to the fore and identify where the growth can be. Of course, they are giving these payments to the farmers, which is good, a short-term move, fine. But in the long term, they have to tackle the unemployment issue. And that means you've got to have people building infrastructure and, of course, bringing them into the urban areas.
Which brings me to my next question, which was an industry that you liked. Infrastructure as an industry is something that you have been liking for some time now, particularly the pipe makers and steel manufacturers, and that was our conversation last time. Is that a space which is still a favorite, and on the back of the fact that you could see some favorable budgetary announcements with the push to infrastructure, does that continue to remain an overweight for you?
Yes, that's continuing to be overweight, and we're looking at a number of companies in those areas, infrastructure related. You mentioned pipes, cables, that sort of thing.
The other pocket of this also that you have been talking about has been the NBFC space. Now, obviously, the liquidity constraints may not be as bad as they were some time ago, but it's still bogging down the system. Do you think that now is the time to probably start picking and choosing from the leftover good quality NBFC names and starting to add more weight in each individual portfolio?
I'm glad you mentioned that, because that's the other area we're looking at, the non-bank financial institutions. We believe that there's some bargains in that area as a result of the problems they've had. And of course, with liquidity coming back, with the new reforms, these companies should do fairly well. By the way, don't forget, these payments to farmers, which will be coming in, will improve consumer companies, and that's the reason why you see many of these consumer-oriented company stocks doing so well. But that also means that these companies that are serving that sector will be able to pay back their debts, and that will help the non-bank financial institutions.
Mr. Mobius, your India dedicated funds, which you said have started focusing on the smaller companies, the smaller mid-cap and small-cap names, has there been any material change in terms of adding new stocks from any particular sector or starting to gain weight from any particular sector?
Well, I would say those infrastructure-related companies, manufacturing companies, are the ones that we've been adding to very selectively. You must remember, our fund is very focused, and we also want to focus on corporate governance. We want to help companies improve their corporate governance. And so we have to pick very, very carefully which companies we deal with, because some companies are not interested in making changes, and we only want to deal with those companies that are going to make changes in their governance.
Do you think this is the bigger problem in the current standing, where we've been seeing the kind of companies that have been faltering on corporate governance and being thoroughly punished by the investors?
Definitely. It's a big, big issue, not only in India, it's a global issue. Corporate governance is now coming to the fore because ESG, environmental, social, governance issues, are now foremost in the minds of investors. I just came back from a trip to 5 major cities in America, and everyone we talked to said, look, what are you doing in terms of the environment? What are you doing in terms of social factors and so forth? And in order to impact those 2 factors, environment and social, you've got to do something about governance. So we want to talk to companies that are willing and able to improve their governance.
So would that tip the scales with regards to the earnings projections of those companies versus corporate governance?
Definitely, because what we've found is that companies that excel in ESG perform better. Of course, you can buy index stocks that have the high rating already, but what we're interested in are those companies that are willing to improve their rating so that they can see an improvement of their stock price as well.
Okay, let's talk about the infusion of liquidity now. And over the last few months, we've been seeing the foreign institutional investors been sitting on the sidelines for a bit. U.S. equity markets, on the other hand, making record highs in anticipation of rate cuts from the Fed this month. Do you see, with all this excitement around U.S. equity markets, the incremental capital will actually stay in U.S. rather than come to the emerging markets?
No, because in talking to investors in America and investors globally who are heavy in U.S. stocks, they realize that they're vulnerable. They have to diversify. Everybody is in these ETFs, for example, exchange-traded funds. They want to get into active managed funds to diversify and reduce their risk. So I believe that as a result of interest rates in America moving down, and as a result of people being overweight in America, then you're going to see some money going into emerging markets. And already we're seeing the performance of the Emerging Markets Fund doing a lot better.
Mr. Mobius, one last question from my end. How have you read into this whole love-hate relationship between US and China, and now that it is presumably showing some signs of resolution, let me choose my words carefully, would you believe that there is a bit of a risk on possibility that could emerge in a big way?
I don't think it's going to be a big issue, because I believe both sides realize that if they go too far, it'll harm both. I believe, however, that the U.S. has a little bit of an upper hand in the sense that the trade deficit that China has imposed on the U.S., where the U.S. has huge trade deficit, 300 billion plus, that means that America is in a much stronger bargaining position. Nevertheless, I don't think Trump will go too far. He will want to make sure that there's not too much harm done to U.S. trade. As you know, the meeting they just had resulted in some concessions on both sides. So I believe that will be okay. Nevertheless, a lot of business from China, particularly in the high labor area, is moving to other countries, to Vietnam, to Bangladesh, and hopefully also to India going forward. So I believe that is going to be an opportunity for India.
Okay. Mr. Mobius, at this point, we're seeing different asset classes also looking interesting from an investment standpoint. Gold has started giving returns after really long. We've seen the money markets in the US working well for investors. So compare that to equities as an asset class, which is already trading at extremely elevated levels, record highs on the equity markets. New capital, does that go into any other asset class? Do you diversify?
Well, you've been hearing about the Facebook plan for a virtual currency. Bitcoin prices, you can see, fluctuating. I think they've been moving up recently. So that's a totally new area which is creating lots of question marks. And I believe one of the reasons why gold is moving up is people are beginning to think, well, maybe we should, avoid some of these virtual currencies and put something into gold, because if these virtual currencies begin to take over, we really don't know where the valuation will be. And you can see the tremendous volatility of Bitcoin is a case in point.
But you wouldn't pull money out of equities to put into commodities.
No. I believe that equities is the way to go, particularly at this stage. But please remember that commodity demand is still moving up. A lot of people look at these commodity charts and they look at the price or the volume in terms of cost, but they don't look at the actual physical volume. And the physical volume of most all these commodities is continuing to move up, which means there's continuing demand for all of these commodities.
All right. Mr. Mobius, one last question before we wrap up this interview. The last time you said that you are ready to put much more money into India as compared to China as well, even if the valuations look stretched. Is that still something you stand by?
Yes. In fact, if you look at our portfolio, you see China is still a little larger than India, but India is moving up. As you know, we had a late start. We had to get permission to move into the Indian market, and that took time, and now we're catching up.
Well, we hope that the stage is set for you to have a very favorable time in your new role in India. Mr. Mobius, thanks so much for taking the time out and speaking to us at Bloomberg Quint.
Thank you.
Well, that's a very important global market voice. And speaking of, his view on the fiscal deficit was very, very interesting.
Yeah.
But as Devina said, we've been speaking to a whole host of people on what India needs to do to determine whether its economic slowdown is cyclical or structural. And now, on that very topic, according to Jahangir Aziz, he mentioned the same things as well. He was speaking to Ira Duggal ahead of the union budget, and Aziz said that it is very difficult to determine whether India's slowdown is temporary or not. Listen in.
We have questions about this actual growth rate, but if you set those that aside, it's performing reasonably well as far as other emerging market countries are concerned, particularly if you compare them to its current account deficit peers. So if you compare them to Brazil or to Turkey or to Argentina or to South Africa, Indonesia is doing reasonably well. So I think there isn't a lot of grave concern about India at this point in time. The question is what does the government do and how does policy move from here onwards in order for India to move up and retain that high growth profile that it's promised to do so. I think a lot of this, at the current point, at the current juncture where people are looking at current account deficit countries a little more generously, is of course because of the Fed being on hold, or actually even promising to deliver rate cuts, and the ECB doing the same thing, and maybe even the BOJ will add to it sooner or later. So I think the global financial conditions are reasonably supportive at this time for current account deficit countries globally.
So then would you be on the side of the fence which says that the government should perhaps retain its broad consolidation, fiscal consolidation path? In fact, within that there are problems such as the off-balance sheet borrowings, etc. Or would you be in the camp which says that look, fiscal policy should be counter-cyclical, there's a growth slowdown, so perhaps there's reason for the government to loosen the fiscal purse strings?
Look, start with the second argument that India needs a counter-cyclical boost to growth. The question is the slowdown in India actually cyclical? I mean, if we haven't even determined that, how are we talking? Why are we talking about cyclical slowdown in India? This could well be structural. Now, in order for us to be able to make that determination, whether India is cyclical, is it a cyclical slowdown or is it a structural slowdown, we actually need to, in the first place, have a sense of what a cycle in India is. Given the GDP data that we have, it's almost impossible to extract any kind of cyclical with any reasonable amount of certainty, or where India stands in the cycle. So I think this idea that this is a cyclical slowdown, there isn't data to determine one way or the other. But if you step back from just the growth numbers and you start looking at what exactly India has been doing over the, let's say, last 10 years, India has more or less tracked what has happened to global trade. So if you look at global trade, growth rate of global trade and growth rate of India, more or less it has tracked that. except for brief periods, let's say, 2013 to 14, when, we went through the taper tantrum, and then in 2016 and 17, when India went through the impact of the demonetization and GST soon after. But by and large, India's growth rate has essentially followed like any other emerging market countries, maybe at a higher level, and it's essentially being determined by what's happened to global trade. So if global trade is something that is being pushed back by anti-globalization forces, or by the maturity or the maturity of supply chain dynamics, and we don't really see global trade picking up, then it's very hard to say that what is happening to India right now is just a temporary slowdown, and a little bit of fiscal deficit, a little bit of demand boost can actually help the matter. In fact, I would argue, that India really needs to consolidate this budget right now. Public sector borrowing is, and I'm including the state and the center and state and central PSUs, is about 9.5% to 10% of GDP. That's a very large public sector borrowing that that the government and the bigger government is imposing on Indian households and financial markets.
All right, to the pre-open then, and the rates up on your screens right now, about 1/3% under for the Nifty 50. Sensex up by about 1.5%, but don't go by these index moves at this point. We'll wait for some more time till they consolidate. But coming down to the individual movers then, yes, Bank seems to have a positive start, about 2.3% now. NTPC 1.2%, Z is up 1%. Adani Ports 1% higher, NTPC, BPCL, UPL, which has been a constant outperformer over the last 1 week, has done well in today's session too. Wipro is up about 0.5%, Bajaj Auto, L&T, some gains seen across the board there. Amongst the bigger losers, Indian Oil is down 2%. HDFC Bank looks weak. Remember yesterday's session, so both HDFC Bank and HDFC amongst the bigger losing contributors to the Nifty. And that looks like it's continued today too. Tata Steel, Power Grid, HCL Tech, they look weak. So, the IT and some of the banks looking weak. IndusInd Bank down about 0.5%. Bajaj Finserv and Kotak Mahindra Bank too looking weak by 1/3%. 68.85, no material move on the currency as well this morning. But the broader market space, I think the advanced decline also pretty even, Stephen.
Uniply and McLeod are still two mid-cap names, so it would be in focus, and Titan because of the Morgan Stanley downgrade. But we'll revisit these stocks in moments from now. Manoj Vayalar is also with us. We'll get to in a bit. But Parthiv, one final question to you before we let you go, and that is on Aarti Industries. Since you track chemicals so closely, it trades ex-personal care business today. Is it good for people to go out and invest in this one?
Certainly, Neeraj. I think this is a company which has done fantastically well in the benzene derivatives. It has tapped in huge international MNC players in the agrochemical space, and it has even successfully adopted a long-term supply contract model, which gives a lot of visibility in terms of its earnings, and the capex for which has already started. And on a capex of 200 crore, they're going to supply for a long-term 10-year sort of a contract, which is upwards of 2,000 crore. So I think that is very, very efficient capital allocation, and we are very, very bullish on this counter. And certainly the specialty chemical business, I think that's the business that the market is certainly eyeing, and I think the valuations no doubt have run up, but the long-term visibility that this company brings and all the capex is doing from the internal accruals certainly gives visibility, and we are definitely bullish on the specialty chemical space, which could be the next pharma sort of a rally that we had seen in pharma when it was emerging market for the US FDA approved product. So yes, I think Aarti Industries is a stock to reckon with.
Parthiv, we'll leave it at that. Thanks so much for taking the time out and being with us today and being patient with us as well while we're doing those couple of global conversations. Well, Manoj Vayalar has been patient too. He's been waiting by. Associate Vice President for Equity Derivatives at Religare joins us right now on the show. Manoj, good having you. And again, thanks so much for being patient with us. Let's start off with your thoughts on the index. Would you trade the index the penultimate day of the budget, or would you initiate any trades only after the budget is out of the way?
Yeah, good morning. I guess first come first basis, if you see it's the expiry first, and we still have one more day for the union budget, let's say, if you have to officially say that. Now what we are looking at, we're looking at a lot of data what the FIs are planning to do. They are using a lot of cross strategies, that is, they are mixing the instrument of an index future along with an index option, and we are seeing some covered calls being done. So what a covered call specifically is, they are buying some index futures and they are selling some out of the money call options. Now ideally the break even as per the weighted average price goes is 11,850 to 12,200. That might be the broader range that the Nifty might trade in, but today specifically for the expiry, we are expecting the Nifty to cross the 12,000 odd mark, maybe a vicinity of 10-20 or more points on the upside. So a better strategy is to buy Nifty futures at 11,920 to 930. Keep a stop loss of 11,870 and the target is around 12,050. And because the Bank Nifty, the ratio at which the Bank Nifty works to the Nifty is generally 3:1. We recommend buying a 31,500 call option for today's expiry. I guess yesterday's close is around 72 rupees. Try and buy it close to 30 to 40 rupees, and you need to hold it till the end of the day, that is till your 3:30 time, and the target that we're expecting on this is somewhere close to 136. So we believe that 31,650 to 700 on the spot is what we might see on the Bank Nifty, and the call option might be closer to 130 to 150, which should be a target for intraday.
Let me get this straight. You are giving these calls on an intraday basis for today?
Absolutely. The 31,500 call option for Bank Nifty is intraday. If you're trying to go for a positional trade, you can still buy the 11th July 32,500 call option. It's a deep out of the money call option, hardly a delta of 0.9, and you get it for 20 odd rupees. Now the target for that would be around 38 to 40 odd rupees. So you can buy that, but if it is specifically intraday, 31,500 call option, buy at 30 rupees. Target is 136 on that.
Seriously bullish intraday basis, Manoj. Let me try and ask you if indeed this is the setup that you have in mind for the indices. What are the specific stocks that you're trading today?
See, we're looking at the contracts or the sectors. The so-called index management is being nicely done, and we are looking at sectors where the money is pouring in, and we are seeing the net cumulative money which is going out of the system. Now we work on a concept called as a hedge ratio. Hedge ratio is nothing but simply your net derivative position which is rolled into the next month versus the Nifty futures that is being carried. So we believe that FMCG and some in the banking stocks, these are the stocks where there is value buying happened and the follow-up might still come in. So we like SBI. We believe that SBI last couple of days there is good traction happening, but we recommend buying it close to 360 to 362. The stop loss should be around 354 in that, and we are expecting a weighted average price of 386 maybe in a couple of days as a target in that. We like Marico as well. This stock, I guess, even the entire month of June, it has been trading in a 12 to 14 point range, but the buying has been good, and we are expecting that to follow up towards 390 to 400 as a target. So recommend buying it at 368 to 370. The stop loss should be 10 rupees on the downside. And we like Asian Paints as well. As I was saying, because I know these stocks have rallied a lot, but then there is follow-up buying and volume weighted average price. The money which is coming in is coming into these sectors, so we have to stick to the trend which is going on. So buying Asian Paints close to 1322 precisely because that is the weighted average price where the risk reward is still better to buy in intraday. The stop loss should be, let's say, 1288 on that, and we're expecting a target close to 1380 to 1382 on that.
Okay. That's a very bullish Manoj Vayalar on an intraday basis. I remember conversations wherein his VWAP calls used to be on the button. Let's wait and watch how these calls shape up. Don't hold him for the levels, but hold him for the bullishness for sure. Manoj, great having you. Thanks so much for taking the time out. Look forward to have you more often on the forum.
Thank you so much.
Well, that's the view from Religare. Let's wait and watch what happens there. Mukul Kochhar, Head of Institutional Sales at Investec, joins us right now on the show. Mukul, maybe some intraday bullishness. 2 or 3 experts have now spoken about this for today. What's your sense, though, when you're speaking to your large clients? Is everybody sitting and waiting for the budget to get out of the way before they make large calls?
So for institutional investors, the budget honestly is not, while it's watched for policy direction, in of itself, the revenue and expenditure statements don't really move the needle as much, because if you just look through the internals, the entire tax generation is spoken about just from revenue expenditure, not leaving much for discretionary capital expenditure. So per se, the budget itself doesn't move the needle much, but of course, the intent of the government that comes out in the budget, that makes a lot of difference. So we'll see what happens, but end of the day, macro is looking good as far as the budget is concerned. if it's any indication of the macro is looking good. Where investors need some direction is some pockets of weakness as to in let's say passenger vehicles, what is happening there, just to sort of see where the direction of the economy is headed.
Okay, so if budget doesn't do much in terms of probably deciding or finalizing the kind of investments you make, which it shouldn't also, because it's a more long drawn procedure, what would be the most near term actionable move from the equity market standpoint?
From the equity market standpoint, the biggest move I think can happen in terms of valuation. So when the prices get right, when there's enough margin of safety, you'll see more people getting in. I think the bigger problem, especially for foreign investors today, is that the market is expensive. Having said that, it should be put in the context of where India stands versus the rest of the world. We are, despite the fact that growth is slowing, we remain one of the most stable constructs or economic constructs throughout the world. We have a stable government for the next 5 years. Current account deficit is being managed. We have good foreign investment coming in. Rupee is stable. Inflation is low. So the economic construct actually is especially good. If the valuations get right, maybe a little bit of correction here or there, you will see more interest come in.
Okay, Mukul, stay on. Let's tell our viewers all that they need to know to stay ahead in trade today. 5 minutes left for the markets to kickstart. First up, Deloitte Haskins. The auditors to McLeod Russell said that the tea company understated its losses worth over 1,822 crore rupees and did not make provisions for advances to promoters. The stock likely to start off 4% lower.
IndusInd Bank will consolidate its merger with Bharat Financial today. The merged entity is likely to have an additional base of 2 crore customers.
Kuwait's Markab has made an open offer for 26% stake in Uniply Industries at 82 rupees per share. The offer aggregates to 406 crore rupees. The stock locked on an upper circuit in the pre-open session.
Morgan Stanley has downgraded Titan Company to equal weight from overweight, but the brokerage assures that there's no need to worry about the financials. It's due to the concerns of the valuations that the price target of 1,300 has been achieved.
Nalanda India Fund has reduced stake in Mindtree to 1.7% from 10.6%. Shares were tendered by Nalanda in Larsen & Toubro's open offer.
Just coming back to Mindtree, actually, 904 now, open offer was at 980. Mukul, what is the trajectory according to you for Mindtree now that, the whole ownership settlement has happened? The growth now takes center stage, and how the financials play out for Mindtree.
Mindtree is an interesting space right now, because remember, this was a top performing tier 2 IT services company. It was also trading at a premium multiple before L&T came in and acquired the company. A lot of the reason for the outperformance of the company was attributed to its unique culture, family-based environment where people like to stay and work. Let's see how L&T preserves that culture and moves ahead. The bet right now, though, from a market perspective, is that there is disruption, there is some slowdown. So I will be cautious on the stock in the near term before we see some evidence of L&T coming in and making this a smoother process than I think it will be.
Okay, Mukul, the other bit is about IndusInd Bank or any of the other corporate-facing banks. We've been asking this as the pecking order for the non-HDFC, non-Kotak variety. What's your pecking order? Axis, ICICI, IndusInd Bank, and some of the smaller ones. Which one do you prefer the most?
So what's happening in the NBFC world, and this is what I've been sort of talking to others as well. So definitely there is disruption in the wholesale lending, wholesale borrowing market. It's a substantial disruption which is causing cost of funding for a substantial section of the financial market. Their cost of funding is going up. There is a section of banks, though, which is benefiting from it. Their cost of funding is stable. They're able to get as much liability as they want. And moreover, their pricing when they lend, that gets better. So, on the one hand, you have NBFCs that are suffering. On the other hand, you'll have banks that will actually be reporting very, very good numbers going forward. So, I will put ICICI Bank in that category, which by the way today is a retail bank. They have 60% of their assets in retail today. I like Kotak as well. I like HDFC Bank as well. Axis is also looking good and SBI is also looking good. So all these are large banks with good deposit franchises where you will see very, very good results come through and stocks should do well.
30 seconds, Mukul. The market is about to start. The merged IndusInd Bank, Bharat Financial entity, not quite there.
So of course, Bhafin is a stock that I used to like a lot. I still like that business. I like it more since it's merged with IndusInd because they get a stable liability profile to fund their microfinance business, which cross-cycle is exceptionally good. So Bhafin merger should definitely help IIB. The issue there is a little bit with the liability side. It's not as granular as one would like it to be, and some of the corporate loans that they've taken. Once the valuation, and we think valuation is a little excessive right now, once the valuation reflects some of this weak liabilities, it's also a good stock to bet on.
Okay. Mukul, stay on. We'll just take in your opening thoughts post the market open. 20 seconds left, or just about 20 seconds left for the markets to kickstart trade. The pre-open rates have suggested that we'll start off marginally in the green. The bank nifty could be the one that could be up about 0.2 or 0.3%. So that one could well drive. Let's wait and watch if it does. And then we'll watch out for what happens to some of those individual movers, particularly in the PSU banking space, because that lot has been very, very excited the last few days. Let's see if they move up in the session today as well or no. But here's how the markets are starting off. Well, about 14 points for the Nifty, 33 for the Sensex, very flat. The Nifty Bank 0.25% higher, so that's the only one which is making any substantive move on open. But even that too is cooling off or tempered. And the mid caps and the small caps, I doubt would be doing anything materially different. Yes, very, very flattish start to the mid cap and the small cap indices too. Bring up the heat map very quickly. The indices are not doing too much, more green than red. Tata Steel is the top stock correcting today. Titan, there is a downgrade from Morgan Stanley. Not a downgrade really, they've just said that they do not push the multiples further and therefore the target price is 1300. That stock seeing some pullback. HDFC seeing a bit of a pullback. HUL marginally higher in trade. So not too many losers. What about the gainers? Z continues to rise and shine. There is strength in Eicher Motors yet again. So good going for that one. On start yesterday too, I think it started off well. Indiabulls Housing Finance, yesterday's peak performer, is up another %. Watch out for UPL. Again, one of the peak performers the last few days, starting off well. Aside of that, a very, very flattish start to the large cap indices. What about the mid caps and the small caps? Very quickly, a couple of pockets that I want to highlight before I hand it over to Devina for what's happening across that spectrum. Firstly, stocks which are trading at 52-week highs yesterday. Torrent Power, Brigade, PNC Infratech. Not a big bang start for any of those. Less or more than 0.5%. So nothing really out there. Next set of stocks would be the ones which have been in focus the last few days. McLeod Russell on that downgrade, down about 4%. Jet Airways corrects another 4% in trade, and Indiabulls Ventures, in line with Indiabulls Financial Services, was a big gainer yesterday, starts off on the 2.5% today. Devina, what are you spotting? 2
to 3 days, in fact, of continuous big gains has led to Religare's 7-day performance being up 30%. Today also up about 7% for Religare. Smaller banks, United Bank, Corporation Bank, these are the bigger gainers in today's session, about 6.5% a piece. 1% beverages, 5% upper circuit. So since the last, I think, 7 to 8 days, there's been no entry point into 1% beverages. It's been on circuit after circuit. You've got the likes of an Allahabad Bank also, which is up about 3.6%. Diwan Housing Finance takes a breather. That stock is up in the session. You've got the likes of an Adani Enterprise, 2.7% higher. UCO Bank again, Lakshmi Vilas Bank, Andhra Bank, all these smaller banks, J&K Bank, is doing really well in the session. Amongst the bigger losers in trade, this morning you've got Eros International, a slump of 22% in the last 7 days. Jet Airways continues to grind lower. Cox & King again 40% shaved off in the last 7 days. Adding to that is today's 5%. Tata Sponge Iron, that's down about 2.5%. Then you've got the likes of L&T Info, which is down 2%. Igarshi, which was up until now, has started to see some profit taking, down 1.3%. And Hexaware from the mid-cap IT space is looking weak. But the overall market breadth still is in the favor of the bulls. 654 stocks are advancing. You've got about 437 stocks which are looking weak at the start of the trading session.
which is not bad. Let's see if this lasts. The Bank Nifty now up about 1/3%. Final thoughts, Mukul, and a pocket that I wanted to check with you, not a very large one, but I wonder if institutional clients and foreign investors are interested in Indian aviation now that it's a two-horse race of sorts, at least on the investable side, and crude prices over the last 2 or 3 days have shown that any upsides for now seem to be capped.
Unfortunately, we don't cover the sector, so I won't be able to give you deep insights. Having said that, of course, the industry construct is getting better. And, with Jet Airways right now completely out, you don't know where the future is headed there. Even Air India seems to be on the block with some privatization moves there. So I would imagine that there'll be a lot of interest, but we're not that involved right now since we don't cover the sector.
Okay, we'll leave it at that. Mukul, thank you so much for taking the time out and being with us today and giving us your thoughts a day before the budget. Important
Thanks
to have those views.
Thank you. Bye. Yeah.
Well, and important to have views from Ganeshram Jayaraman. He's Managing Director for Institutional Equities at Spark Capital, joins us right now in the studios. Ganesh, good having you. Thanks so much for joining in. Bullish, bearish, neutral, and why?
So we've chosen a middle path. Our assessment is that we are still in a growth moderating phase. We are still in an earnings downgrade phase. Fiscal 19, if you see just the earnings statement, shows that earnings grew about early teens, 13%. But if you look at operating cash flows, it kind of declined year on year. Okay, so companies were basically pushing their sales, stuffing the channels in some form, and that led to sales and EBITDA looking good, earnings looking good. But that didn't convert into cash flows yet because those dealers and distributors have not sold it yet, which basically means you have advanced some next year sales into this year, and that's something that we believe will have an effect on fiscal 20's top line earning, bottom line expectations. Also, our assessment is that when we look at the lead indicators, which tell us 6 months in advance, we are not able to get confidence that we have got back, we have turned the corner, and we are going back into a growth phase. Because there have been two paths which policymakers have chosen over the last, all these years. One is a quick fix, fiscal boost, monetary easing, do a restructuring, hope for foreign flows, and that revives growth. And that's a good quick fix. If we know that is indeed the path, you can position your portfolio accordingly, right? At least you know the next 12 months, you are going to see pickup in earnings, you're going to see growth revival. We are not able to decisively tell that is indeed the path we will take. The other path is a little more structural. It takes time. It's natural immunity in some form. It doesn't mean a quick fix. It takes time, which is savings to improve, for bond yields to come down, for interest rates to transmission to completely happen, and that starts percolating with the 12-month lag. It takes its effect on earnings. Maybe our assessment is the priorities will have to move to a more investment-led growth than a consumption-led growth again. That's not going to happen, in the next 6 months. It's going to take time.
Likely the budget will also not show that.
So fiscal, our assessment is there isn't much leeway for a fiscal-led rebound in growth again. The fiscal deficit is one, but if you actually look at the overall fiscal, not just the disclosed fiscal deficit, but off-balance sheet, the state governments, the electricity boards, and the combined fiscal deficit, in our assessment, that is in excess of 9%, okay, already. Which basically means there is, and if you look at it as a proportion of the incremental money supply that we create every year, in our assessment, it's already 70%, okay? That leaves very little effect for further legroom, for fiscal impulse to translate as growth effect into the economy. We have already used those levers over the last 3-4 years. For private sector capex to pick up, given the fact our household savings has been falling, we clearly do need levers which go beyond the shores of India. The overseas flows need to come into India. We've done the math. In our assessment, we need a bare minimum of $25 to $30 billion, and ideal situation is $50 billion, but that won't happen initially. So at least $25 billion of, in some form, global savings to find its way into India to help us get a growth kind of a momentum going. So without clarity on or decisive trend, We don't know if we will choose the quick fix route or the long fix route. So we are preferring a middle path in our client portfolio strategy. If we were more cautious like we were in 2018, we would have said by safety, buy stocks which have a track record of 15, 20 years, even if they are 40, 50p, don't worry, they will be where you should hide. If we were as bullish as we were in say 2016 or 17, we would have told investors, buy cyclicals, buy cement, buy construction, buy NBOCs, buy infra, buy automobiles. That confidence is also not there. So our preference is a middle path, which is large cap value stocks, which is stocks which have limited valuation downside. They trade in their vis-a-vis their last say 10 years traded history. Today's valuations are in the bottom quartile or bottom decile, whereas earnings also have a lot of further improvement leg. So which means we don't see downside risk, but if the tide turns faster than we think, they also stand to benefit. But if the tide doesn't turn, there's not much downside. So it's more of a hedged
capital
or it's
protection.
more of a protection. So clearly defensive mindset, but within that it's not the usual costly defensives which were till about 3 months back our preferred pack. It's now more the value stocks which are incrementally our preferred place for hiding. Yeah, that's on the large cap space, but when it comes to mid caps, it's a very different mindset for us. We tend to look at life with a 3-year perspective, which managements are doing. It's more bottom up, where who can gain market share, who's launching new products, new geographies, capturing new markets, or sunrise sector, or margin improvement, balance sheet improvement, re-rating potential. So our portfolio strategy it kind of straddles large caps, value, mid caps, very, very bottom up. This is our broad way of approach today.
From a budgetary standpoint, and if you have to look at individual sectors, is there anything much expected in terms of a dole out from the finance minister for the auto industry, expectations on the two-wheeler, small car tax rates, affordable housing push, cement and the tax rate tinkering out there? Do you think all of that can happen? There is
we actually have very little expectations of the budget, and I don't think honestly the market is also expecting a lot of material delta. All said and done, this is just a month old and it will take time. What we want is broadly see is some directional trend. Are we going to be in a tight fiscal consolidation path, or are we going to be in a further leg up on spend on fiscal front? That's something which I want to watch as broader direction. Also some more key initiatives on the policy side. Do we want to see a strategic disinvestment as our path going ahead? Will something be told or done? I'm not too sure it will be made any big bang announcement. It tends to be made a little more stealth, but we want to watch that as some kind of broad policy. But our assessment is we are not going to see a big government spend push or a dole outs or incentives. That's not in our base case. That's not what we expect. We are also watching the NBOCs, the real estate space very closely. We want to ensure that doesn't translate into any kind of contagion, and I don't think those are all things in a budget or any policy making can be done. It's more realities on the ground which matter more. So to me, budget is not going to be a big driver of even the shorter term priorities, unless something unexpected turns up, which
so we've been talking about how consumption needs to pick up, and that will lead growth going forward. And we were just in conversation with Mark Mobius, and he said that even if there has to be a little bit of a fiscal upheaval of sorts, India has the headroom to go up to even 5%. That's his opinion, and that will not deter a foreign investor from investing in India if that uptick in fiscal deficit spurs consumption and spurs growth.
See, if the 5% is what is just on the government's disclosed fiscal deficit, yes, there is leg room. In our assessment, we are already at 4.5% because we need to also look at what the public sector companies, not companies, but more the departments or undertakings, enterprises, they also tend to borrow. It's more off balance sheet. So in our assessment, we are already used up that lever for consumption.
Okay, so final question out this, Ganesh, would be then, in light of that, if you are choosing to have a middle path of this thing, what could derail this? Would it be a global event, or would it be earnings not picking up in India? Because your base case seems to be that earnings growth also will not be high.
Correct. Global, I'm not too sure. There could be 100 moving parts. But the broader trend is rates are going down globally. And that could be a tailwind for global flows. So that's one thing which we need to see. I don't see that reversing anytime soon. But that's not my base case. My base case is basically things to improve in India. For that, what all can change effectively? I'm not able to decisively tell that these tailwinds will help pick up growth. We need to possibly buy time and then get confidence. So till then, it's more caution first mindset.
Maybe that saves money if it doesn't earn money, but even that's not a bad thing. But Ganesh, so good having you. Thank you so much for taking the time out and joining us today and giving us your thoughts.
Thanks.
We need to slip into a break on the note that the Bank Nifty is up 0.6%. On the other side of the break, Tata Steel CFO Kaushik Chatterjee explains how the company is hoping to turn around the European operations after the ThyssenKrupp JV fell through.